arguments about how to survive in markets. So the most important things about this masterclass is that we are teaching you how to survive. We are giving you many knowledge about financial market, especially in the sector of trading. We are not here for talking about investing long term and gaining portfolio and gains in portfolio management. We are not talking about long term. We are talking about short term scalping strategy, intraday strategy, and how to really build wealth based on the variation, the fluctuation of prices during the day. So it's very important that you understand if this masterclass again are made for traders, are not made for investors. Of course, investors are and will be very, very allowed to join and listen about these topics, but the main key of this masterclass is again teach you on how to stay alive by day trading. So day trading, I'm gonna start sharing and explain to you the mental map that I prepared for tonight. But first of all, I want to comment a little bit because it's not gonna be easy. These concepts are very complicated concept because we're gonna talk about statistics and not just I'm gonna put it off just a second, the notifications. I hope you are seeing and everything is very smooth. So again, this concept that I'm going to show you tonight are not easy concept. These are very difficult concept to understand and to explain as well. But I am explaining this concept because it's very important that you understand that your trading strategy is not just luck. Your trading strategy is not just put a trade and hope the trade goes to profit and hoping not to lose as much money as you can. No, your trading strategy needs the manual part of the strategy based on your effort, but in the near future, your strategy, if gain results over the time, need to be automated. So we're gonna cover a little bit of the part of this masterclass in statistical trading and I would say automatic trading. So later I'm gonna explain to you, but focused on the most important part of trading, that is manual trading. Manual trading is based on many factors that affect your operativity. What affect your manual strategy? Psychology, for example, and we covered the topic of psychology during the first masterclass that we had. I don't know how many masterclass we had right now, probably 6, 7. This is the seven masterclass, I don't know, but we're gonna have 4 to 5 masterclass probably monthly for all 2026. I don't know. I don't want to spoiler you something, but we're gonna have many appointments together, and it's gonna be fun. We are gonna touch a lot of topics. The topic of tonight, again, based on manual trading strategy, on our manual effort to do results in the market. It's very important that we just remember. It's very important that I just remember you that in the past masterclass we cover many topics like psychology, volatility, my trading strategy, and all the components of what today we are going to understand are part of a very important and specific argument, that is statistics. You have to have in your trading strategy statistics. You have to know how profitable is your trading strategy. You have to know the way of calculating the risk of ruin of your trading strategy. You have to know all the ratios about your trading strategy. You have to know all the drawdowns condition of your trading strategy, win rate, profit factor, position sizing. Okay, you have to understand that it's really I'm so sorry, Discord is bombarding me with a little bit of I see now the Okay, I hope you are seeing now. Let me check. 3, 2, 1. Hope so. Thank you. So again, you have to understand that your trading strategy is based on, I will not say hundreds, but I will say dozens and dozens of factors that if you don't take care of just a single one of them, you cannot use this strategy for long term because you don't have. Okay, I am muted right now. Why I am muted? Are you listening me, guys? Oh my god. The good part of being live is that always something doesn't work. Always. There's always something that doesn't work. Okay, but right now I think you're listening. So again, hope it's the last time that I stop. Again, your trading strategy is composed by, I will not say hundreds of factors, but I will say dozens and dozens of factors that compose and make great your trading strategy. So it's very important that before you go live and before you really go for the strategy for the long run, you understand everything about the back testings, about Monte Carlo simulation, about the risk of ruin, about the shape ratio, selling ratio, maximum drawdown expectancy, everything, and a lot of other formulas that we are gonna covering tonight. I want you guys to be profitable. I don't want to people lose money. Even if losing money is part of the process, you have to lose money to have a good results in market. If you don't lose money in the markets, probably for a little period of time, of course, I don't want to guys lose money forever. I just want to lose money for a little bit of period, just to understand that this market can take everything from you. Okay, just to remind yourself that you are in financial market. You are not playing games. You are not playing with, I would not say zero capital, because of course you are playing with capital. Even with a prop firm, you are playing with capital. You are playing with a challenge fee that you pay for access capital for and that allow you to trade in bigger sites. So you are risking money in financial markets. So you need to lose money to understand how really careful you need to be in this market. So I hope everybody, for a short period of time, lose money to understand that you are not in a game. You are in real life risking and put your hard, money on stake. So it's very important that you give this market the right importance. Okay? So let's start about statistical trading. Tonight we're gonna cover this topic, statistical trading. We're gonna talk about probability thinking. We're gonna talk about advantage and disadvantage and statistical methods, core principle and definition of statistical trading, data requirements, of course, for a statistical trading strategy, the tools that we need to use, edge for a trading strategy. Again, these masterclass are built for traders, but edge for a trading strategy everybody needs to have when it's come to getting better and better and better in risk management. Okay, then we're gonna talk about risk distribution, portfolio risk, position sizing, drawdown distribution as well. We're gonna talk about risk expectancy. Okay, we're gonna start talking about the definition, the expectancy formula, the example of the calculation on how you calculate the risk on a strategy, the expectancy per dollar risk, position size connection, risk management, and the example, and etc. But I think the most important part of the masterclass will be the results in trading, our results in trading, and the tracking of these results in trading, the calculation of our factors that compose our strategy. So we're gonna talk about the back testing process, the Sharpe ratio, sorting ratio, maximum downs ratios, and win rate. Of course, we're gonna talk about the profit factor, position sizing, and the common pitfalls of our trading strategy. So, most important thing, you have a strategy. If it's yes, put your strategy on a tracker. First things first, because you have to daily see what you are doing. You have to see daily what are your percentage of return, percentage of drawdown. You have to see daily every section of your strategy. So the first thing that I always recommend is to buy or just subscribe to, I don't know, I don't want to make software names here, but a really low profile, low quality as well. You don't need high quality data, you just need datas. Okay, you don't need Python code for understanding your strategy. You need Python, or you need another type of code as well if you want to build a really well prepared statistical trading strategy that allow you to manage your strategy automatically. I will say everything is going smooth. Okay, perfect. So again, you don't need high quality software to monitor your trading strategy. You can do for free, but it's very important that you put your account. And of course, if you're trading with a prop firm, it will be a different situation. But I hope that everybody is well prepared when entering in prop firm space, and you need to know about these things. Okay, so statistical trading. Let's start with all the results in trading and calculation. I think this is the most important part of the masterclass. Okay, talk about profit factor, win rate, position sizing, and etc. Our trading strategy, again, unfortunately or fortunately, is based on our actions. Okay, everything is based on our manual actions. Okay, so everything fit into the family of the probability thinking. I act in the market because I'm probably thinking that the market is gonna drop, is gonna pump, is gonna do something. Okay, so everything that composed our manual trading strategy, and I'm saying manual and not automatic, because automatic and statistical we're gonna cover later, not for so long, because again tonight it's not an easy masterclass. It's something that we need and we take time for explain. But again, probability thinking. What is probability thinking? Okay, first of all, in our strategy we have to think in R. What is R? It's risk. Okay, risk plus one, risk less one, sorry, or risk plus three, or risk plus two. Okay, we have to standardize the risk. We have to understand that each session have a type of risk. So I should probably take some Bitcoin chart right now, but I don't want to lose a lot of time and give the right time to every part of the masterclass. So we have to understand that each session need to be properly categorized into different risk, I will say risk ticket. Okay, like a proper risk for the session of Monday, proper risk for the session of Tuesday, because every session have different volatility and every session have different behavior. So we have to understand that we cannot always respect the same risk for the same session, for the same trading price section. It's very important, and I'm not talking about over leverage on Monday and then stay sad without working on Tuesday because you did mistake on Monday. I'm talking about categorizing the trading session by giving them I would say a rate, a category. Okay, this session is plus rate one, plus risk one. This session is less risk one. So a session that I need to really put risk it on because I'm very comfortable and I'm very sure of what the market can do. So I need to understand which type of risk I need to use in this session. Okay, this is what a professional trader do, and I'm not talking about myself because I can think I'm a professional trader, but professional traders are on another scale. Professional trader, we don't even know the names of the real professional trader. They are so low profile and they manage so high quantity of funds that we didn't even know. Okay, so I'm not categorized myself as a professional trader. I'm just here to explain things because I gain knowledge from almost a decade of financial market. Okay, so first of all, when we look at the market, we categorize the session into risk levels. Level 1, level 2, level 3, level less 1. So when I have to lower the risk and standardize the risk. Doing that, we have an emotional neutrality because first of all, before starting the session, I understand that I'm doing what? I'm allowed to take a risk. I'm allowing myself to take a risk because I am standardizing the session. I create a standard. Guys, I'm so sorry, but in an hour of masterclass, I cannot open so much myself and start cover every single freaking topic. Okay, so how can I standardize risk? How can I understand if in a session I need to use double the risk or lower the dose of risk that I use normally? By understanding which data I have in favor, by understanding if all my volumetric analysis data are in a condition of offering me a really high edge by my side. So it's very important that you put a little bit of brain when you listen to this masterclass and you start connecting the dots by yourself, because I cannot connect a lot of dots for you, because otherwise I will give you the plate ready, and I cannot give you the plate ready. I don't want to give you the plate ready to, okay, I will copy paste a strategy, I will copy paste the way of thinking, Richard. No, you have to create your own strategy, create your own mentality in financial market. Okay, so how can I, and this probability thinking, I'm just putting here as a provocation, like we have to kill the probability thinking. We have to cancel the way of, I open my laptop, I think the price gonna go up. Why the fuck you think the price gonna go up? You have to have data by your side, risk management by your side, risk of ruin ratios by your side, simulation by your side, where you are allowed not just of probably I think the market is gonna do something, but you are removing this probability from your trading behavior. Okay, because here we are talking as well about a little bit of psychology. Remove the thinking, remove the probability, remove the doubt, just thinking about actions. I standardize risk, I will be emotional neutral because I am allow myself again to understand which risk I'm using in this session. I'm giving myself the permission to open a position with the risk I already have planned. Okay, there is, all strategy need different building. Okay, no trading strategy is the same. My trading strategy will be completely different from yours in a few years, in a few months. Everything can change. Okay, so probability thinking, by killing the probability thinking, we are standardize the risk, we become emotional neutrality, and of course our trading strategy need a proper Monte Carlo simulation. What is a Monte Carlo simulation? Monte Carlo simulation is bullshit, I would say. I'm saying this because I think is really what a lot of people outside will try to upsell you a trading strategy just by, okay, look at my Monte Carlo simulation. A Monte Carlo simulation means nothing for an automated strategy that somebody wants to sell you, like an algo, an algorithm or copy trading based on automatic strategy and everything. I never show nobody a Monte Carlo simulation of an automatic strategy that I want to sell to somebody, because Monte Carlo simulation is an equity curve illusion. Okay, but for our manual trading strategy, it's very important that we, for ourselves, not for the others, our trading strategy need to fit for ourselves, not for other people. I don't give a fuck if other people think my trading strategy is not so good. I don't mind if people look at my strategy and say, I think this strategy it's a fallacy strategy, it's a fail strategy, you know. I don't mind, because if I'm having result with my strategy, and for myself the data and the edge that I gain from the market by using my strategies are good, and I generate results perfect, I don't need approval from the crowd. Okay, but for myself, and for allowing myself to have more data as possible to confirm that I'm doing the right things, because guys, again, all these masterclass and effort and work that I'm put for help you in financial market is because we are here, what I was saying, sorry, we are here for having more and more and more data by our side that confirm that we are in the right path. If all the data that we are covering tonight start to showing you that your trading strategy probably need to be changed, that your trading strategy has a lot of failure, that your trading strategy has a really low Sharpe ratio. What is a Sharpe ratio? It's a basic formula that calculates the return less the risk-free rate, and this creates the standard deviation. Results less than 1 are very poor results. So all this effort and work that I'm putting by explaining you these things is because more data you have, the less time you spend changing strategy. Because I swear, and I know that people, probably some of you, probably some of the people that are going to watch this recording in the next, who know when, they continue to change strategy. They had a strategy for the first 3 months of the year, then they changed the strategy because the strategy is not generating results. But which data are you looking? Because probably there is 90% of the formulas that are great, like the Sortino ratio, the max drawdown expectancy, the win rate, and the Sharpe ratio, and everything. But then just a little formula is not showing you a good results, and then you quit the strategy. Probably the strategy went great, but then you are stupid. I'm sorry to call you stupid. I'm not calling you stupid, but I call myself stupid sometimes when I do mistakes that are not planned. Because a mistake that is planned, it's totally fine. When you plan to make a mistake, because psychologically you are fucked and you say, okay, perfect, I'm planning to do a mistake, then it's no problem at all if you allow yourself to do this mistake. But when you don't plan the mistake and just do the mistake because you lost your mind and psychology you are in a hurry, and then you start losing money and losing money and losing money, and use strategies that I put here, martingale, anti-martingale, we're gonna cover later this kind of strategy. But coming back to the point, you cannot quit a strategy after 3 months without having everything about the data that you need to know in your strategy by your side. Again, a win rate of 30% is still very good win rate if you use everything as planned. You have to plan properly, guys. You cannot just enter the market and say, okay, I want to make some money because, I have to pay rents, I have to pay staff, I have to pay people. Nah. Okay? This is not your market. This is not what the market is for. Okay? Market need to be treated in a way that you really understand that you can lose everything by just gamble for a few days or for a few hours, for a few minutes, guys. If you just wrong a little number when you put the lot size of your operation, you can fuck it up your entire account. You know better than me probably. Okay, I'm not here to talk you about this basic stuff, but you should remember yourself that trading is the only job, is the only, I would say, business opportunity. Is not just a business opportunity, it's an entrepreneur path that you need to choose. And you have to understand that a mistake will cost your life, a mistake can cost you years of work. And it's very easy to make mistake in this sector. It's way more easy than do mistake than do better. Okay, so again, coming back on tonight, I don't know how many time the masterclass is gonna take. I'm a little bit slower. I want to explain all the concept to you without being in a hurry. But I think in these first 30 minutes we cover many important things as well. So results in trading and calculation of these results. How I calculate these results. I didn't cover the risk of ruin in the probability thinking of our strategy, but what is the risk of ruin? Risk of ruin is a ratio, it's a data. Okay, I will say MyFX Book, for example, is a software company that allow you in a very easy way to monitor your trading strategy by just putting the data inside of their feed, data of your account, and they're gonna start calculate everything based on your strategy. Sharp ratio, Sortino ratio, max drawdown, win rate, everything about the results that you are having daily, weekly, hourly, the peak time of your trading, the peak results that you had, everything. Okay, so it's very important that I'm not telling you subscribe to MyFX Book, but just thinking about a software that allow you to have a really good control of your trading strategy. Okay, so what is the risk of ruin? The risk of ruin is a really good data that you will find in every software that allow you to understand your trading strategy. And the risk of ruin allow you to see if you are over leveraging and then show you the real danger of over leveraging. Okay, the risk of ruin, of course, cover the mathematical ruin of your trading strategy. And I brought it here. You die from wrong sides, not to bad trade, because bad trade exists. Okay. Again, standardize our trading strategy. We are allowing ourselves to be wrong. There's nothing bad than being wrong with the wrong sides. So if you are wrong, just think twice before putting the sides so high. Okay, I think at the end of these 2 months, probably at the end of February with the next masterclass on the 27th, if you're gonna watch again all the content that I give you for the past 2 months, already 8 masterclass probably, around 8 with the last one in February, you're gonna have a real proper trading strategy that you can create by yourself. Psychology, volatility, liquidity, we cover a lot, risk management, risk distribution, trading plan. Now we are covering statistics. Okay, you can build up all together and create a really profitable strategy. Okay, but a profitable strategy needs control, need informations. How do you gain information? Unfortunately, by your eyes, you can just see gains. You can just calculate how much money are you doing right now, but how much money are you doing is not how your strategy is performing. We have to separate these things. How much money you do, so the gross revenue of your trading strategy, and then from the gross revenue you have to pay tax. If you pay tax, you have to calculate a lot of things if you want, or if you want to live in the Alice in Wonderland world, then just open some trades and start and hope that nothing goes wrong in the near future, because it's a entrepreneur path. You need to cover yourself from months that probably gonna cause you a really big stress, because January can be very good, but then February, March and April will be the worst months of the year. You are covered, or you're just thinking about, in one trade I will solve all my problems, I will solve 3 months of bad trading. No, this is not working, because otherwise you're gonna completely wash out all the data that you have been building. So now we're gonna start cover all the topics that I prepared for tonight. But first of all, again, please remind you that you have to build a strategy and have control over the strategy, and don't make mistakes, because otherwise you are cancel all the ratios that you were building in the past. So I'm very okay, let's keep this topic, because it's a very important topic about how you trade your ratio, how you trade your Sharpe ratio, how you trade your max drawdown ratio. I don't want to fuck up my datas, because my datas are public as well. All the people that want something from me, they have my datas. So I cannot fuck up my data just by add a bad trade and okay, that's it. No, a bad trade can erase and can create me a lot of problem in my public results. Okay, so when you trade, remember that in a few years, people would like to see your results. People would like to see how your trading strategy has performed over the years. People want to see what's really is about your trading strategy. So start from now monitoring what you're doing. Start from now taking advantage of a really easy software that allow you to really put the point on it. Okay, so backtesting process. Backtesting process is something that you need to pass through. Okay, you need to pass through a lot of backtesting by historical simulation, walk forward analysis, out of sample testings and parameter optimization to enter in live market. I always recommend everybody, before risk real money, and we are not just talking about prop firm money or real accounts, we are talking about everything. Before put an investment, because everything you do in this market is an investment. Either if you buy a prop firm account, it's an investment because you are investing in your future. You are looking forward to being funded and to have capital to adjust the size with this capital and trade with bigger size. So it's an investment. What is an investment? It's looking forward. An investment is taking care of the future. You do an investment because you want a better future. You do an investment because you don't want to lock your money in the present, but you want to lock your money for the future. So everything is an investment. When you buy a prop firm account, when you put money in a real account and start trading, it's an investment that you are doing. So before do every type of investment, but you can do whatever you want. And people, I'm talking tonight, but I'm talking to not just you, but in generally, before do every kind of investment, do backtesting, do historical simulation of the strategy, walk forward analysis, out of sample testing as well, optimize parameters. So allow yourself to see, and Monte Carlo simulation as well. Create an equity curve that probably gonna elude you, probably is gonna fool you, because this is what Monte Carlo simulation do. It fools you, because it's take the last 30 years, the last 20 years, the last 10 years, the last 5 years, 5 months, 1 month, whatever is the temporary time, the timeline that you give to the simulation. It's gonna fool you, because it's gonna create and generate results that has been great in the past, not in the future. So it's a simulation, of course, but it's a simulation, and tomorrow if a flash crash arrive, the Monte Carlo simulation allow you to see in a certain way, yes, but it depends. It's very dependable. Okay, so first of all, create a backtesting process. Then start to look at this ratio, Sharpe ratio and Sortino ratio. These are the most important ones. So what is a Sharpe ratio? And what is Sortino ratio? These are two formulas that allow you to understand how they are created. Return for the Sharpe ratio. Okay, so first of all, the Sharpe ratio, I brought it here. It measures the risk-adjusted return. So Sharpe and Sortino are two metrics that allow you to see the risk return of your strategy and the downside return of your strategy. So the Sortino, I will say, is the drawdown formula that you need to understand to calculate and to prevent drawdowns, to prevent the bad part of your strategy. Okay, that could be drawdowns. And the Sharpe ratio, it's the opposite. The Sharpe ratio measures the risk-adjusted return. Based on what? Based on the return less the risk-free rate of your strategy, and then create the standard deviation. Okay? The Sortino ratio, return less free rate, and the downside deviation. So either the Sharpe ratio and the Sortino ratio, I will be very fast because I want to fast a little bit the masterclass because we have a lot of topic to cover. Either the Sharpe ratio and the Sortino ratio, it's very important that you understand that each value of these two formulas have to be +1 to be, at least I will say, decent results. All results of the Sharpe and the Sortino less than 1, guys, it's not a good result. It's not a good data. Less than 1. Okay, maximum drawdown. Okay, largest peak through to the clean. You need to know in your strategy when was the max drawdown that you had, the time that you had this max drawdown, why you had this max drawdown. Okay, because try to understand the max drawdown will allow you to measure the worst case scenario. So if you had January loss and loss and loss and loss and loss, okay, maximum drawdown, guys, it's normal to have a max drawdown plus than 15%. 15, not 50. 50 is something dangerous, because if you arrive at those 50% drawdown on your trading strategy, you're fucked. I'm sorry, but you're fucked. Like 50% drawdown in a trading strategy using the proper risk, probably you need few months of backtesting, because 50 is something very bad of a trade for a trading strategy. My opinion, the biggest trader out there, people that wins and wins and wins, price and price and price, they did 65 less drawdown in 2023. I think the new championship, an Italian guy, an Italian old man, he did 65% of drawdown, and then it generate 300%. Okay, what is the Sharpe rate of this strategy? 5. Okay, what is the risk return of this strategy? 5. So you risk 1 for generate 5. You're doing 65% of drawdown for making 250. So it's not I would say a proper risk management. But I didn't win any award prize, so I'm not allowed to judge other people. But if you had results in this market, I will take my hat off and say congratulations. But I need to say my opinion, and I need to talk about my opinion. So I prefer maintain a really low drawdown, and 10% to 15% it's low drawdown. So whenever you see a My FX book or a FX Blue link for strategy, for look at the results of other people. If you see 10 to 15% and say, oh my god, 15% off drawdown in this strategy is crazy. Why I need to why should I give my money to this person that have a drawdown peak of 15%? 15% is a good drawdown, guys, my opinion. Okay, because you can pace through months and months and months of bad results, and if you still don't reach 15% in drawdown, it's because you are in a good condition, okay? Because you have control over your strategy. I give you all this insight because I want that you have control over your strategy. I want you to perform better and better and better. So, win rate, then we're gonna start talking about this topic now. I'm just making sure that I am sharing and everything. Okay, win rate. What is win rate? Win rate is the key to understand if our trading strategy in the long run is profitable or not. Allow myself to tell you that if you think about the win rate in a way that like 2 months, 3 months, 4 months, 5 months, and you just take these months as a statistic edge, like, okay, I will base the results of my strategy on 5 months, and I will say this 5 months, no, this is nothing. You need at least 1 year to really understand if your win rate is good or not. I don't know how many years you guys want to spend in the market, but I hope you understand since the moment you begin, probably you are not with real money right now, probably you're just with a prop firm, probably you are understanding this is a public live in the Discord, so probably there's people that are not already client of ATS, but you need to understand that if you want to make quick profits in this market and then let the market, you're doing something wrong. You have to allow yourself to be in this market for much as you can. This market is not for amateurs people. This market is not for people that just want to make some quick profit and go and bam, I will let the market. This market is not for me. So who have big results are people that understand that they have to give up their life for the market. I always repeat, I'm not Tony Robbins, I'm not here to motivate you or demotivate you, but you have your balls on the table and say, I understand that I need to give the markets my time, my personal life, because you need to have this in your mind. Your personal life will be compromised and will be 100% compromised when you do the decision to enter in financial market and to really work in this market as a professional player. You can be a professional player even if you are not worth $100 million. You can act like a professional trader even if you're not worth like Wall Street traders playing in big banks, investment funds and everything, okay? You can play like them. You are allowed to play like them and to think like them. You are allowed. Probably you're not gonna have the same results, financially speaking, but you're allowed to do the same things. And what they think, they generate results and they think about the results of their trading strategy based not on weeks, not on months, but on years. Okay? You should allow yourself to take years of failure, years of success, years of results, and then you can arrive with proofs and say, okay, I have to change everything, you know? Why? Because the balance of this year is negative. I know many successful people that are fucked because they only weigh and look at the market or business as well in months, in weeks. They don't see results in week, they quit. You are a loser. You quit after not seeing results for a few months, loser. You quit because you are not seeing results in a few days or in a few weeks, loser. For me, that's facts. I don't need your approval to understand if I'm saying right or wrong. You are a loser if you quit because you are not seeing quick money and quick results. You know why you are not seeing quick results? Because the market doesn't give money to people who expect something in exchange. The market doesn't owe you nothing. You owe the market money. The market doesn't owe you money. Okay? So, results in trading and calculations. And we have to talk about the profit factor. This is another formula that need to be in your trading profiles, trading strategy profile, I will say, trading strategy batch of datas that again allow you to understand if you are profitable or not. The profit factor is, I will say, one of the most important data because it's calculate the gross profit versus the gross loss. So the profit factor above 1.5, I will say 1.5 to 2 above is a good result. Okay? Then we're gonna cover the position sizing, common pitfalls, and the results interpretation. But stepping back and just cover a little bit of the risk expectancy. Okay, what is the risk expectancy? The average amount expected to win or lose per trade over many trades. What is the expectancy formula? The win percent per the average win less the loss percent and the average loss. So let's do in an example. I prepare some example here, but like a 40% win rate, like $300 average win, and a 400% loss rate, like 100%, like $150 average loss. Okay, the results, what is this? What are the results? 0.6 per 300 less 0.4 per 150. It's $120 per trade. So you can still be profitable, you can still make money, even if you have a really low win rate. Okay? It's very important that you allow yourself to have years of backtesting, months of backtesting. Okay? Risk expectancy, improve expectancy, of course, increase win rate, increase average win size, decrease average loss size, and better entry and exit. So everything need to be proper, prepared, and planned before trade. Even your win rate should be planned. You have to plan to have at least 30% win rate. When you reach the week or the month that you are not reaching at least a 30% win rate, then here you are understanding something is not right, something is wrong. Okay? How we cover the risk management part and the real example of the risk management part as well. Okay? The risk management we cover in a past live, in a past masterclass. Okay, the risk management is what keep your strategy alive, because here we are talking about datas and how we can read that datas and how important it is to read the datas of our strategy. But the most operational part, like the real part of the strategy, that is the operational one, yeah, the part of where you enter in the market and the part of where you execute trade, is based on the risk management. Okay, so the risk expectancy of our statistical trading strategy should be divided into profit targets. You need to have profit target that gonna respect your win rate again. Trade frequency as well. You need to know when to trade and how to trade, which session you're gonna trade, and respect these data too. Doesn't do like Gaussian Sharpe ratio. Okay. Trade frequency, profits target, expectancy in guide, stop loss placement, everything need to be properly planned. Okay. And then another example of a strategy with 0.6 win rate. Again, same example, $500 average win, 0.5 loss rate, $200 per average loss rate. What are the results? a $2,200 expectancy per trade. I put very low number. It's very important that you argument and you think about what I'm saying and what I'm explaining in a fast way, because I'm explaining, even if I'm slower tonight, I'm explaining these topics in a very fast way, because it will be impossible to deep dive in the win rate, maximum drawdown and Sortino rate and the Sharpe ratio rate, but deep down for serious, like deep down and understand how that formula are really mathematically calculated. I show you a very easy way to understand what is a Sharpe ratio, okay? Return less risk-free ratio and the standard deviation, point, okay? Yeah, I think we are gonna cover the risk distribution, and then these are the topics about the statistical trading strategy of the automated one. I think we are gonna cover in another masterclass. In the masterclass of the 27, we will have, just let me look at the topics of the masterclass of the 27, and then we're gonna have another 4 appointment in March. I am confirming you 4 appointment in March. But the masterclass of the 27 gonna cover, just give me a second because I'm seeing here in the calendar, multi-time frame execution, scalping with context. So it would be interesting to having more time, because I'm already boring yourself with almost an hour of masterclass. So this topic on my right, so the tools for our statistical trading strategy, Python, MATLAB is something that everybody can join. Trading platforms and backtesting engines, as my FX book and FX book I told you. The data requirements we're gonna cover in the next masterclass, so the historical prices, volume, fundamental data, and alternative data. The disadvantage and the advantage of the statistical trading, is the fact that they remove emotion, they are scalable, repeatable, testable, and they have objective rules to follow. And the disadvantage that they require large data set, so you need much more data if you can think, model risk and overfitting danger and changing market regimes. But all this stuff, I'm just citing you just a little bit. The advantage we cover the statistical methods, peer trading, arbitrage, market microstructure, momentum and mean reversion, and the core principle. We can cover in the next masterclass, because we are not running out of time, but I want to give the proper time to these specific topics. Okay, we are not running. We have time. We're gonna have many masterclass, and the most important is that you doesn't get bored in our time together. But I think tonight, at least till now, we cover interesting things, and I speak by my heart when I say you my personal opinion about the path that you need to follow in the market. Okay, so risk distribution, we have to accept and allow ourselves. I like this word, allow myself. I'm allowing myself that I need to understand in a certain way that my trading strategy need different level of risk again. It needs a portfolio risk, a position sizing risk, and a drawdown distribution risk. What is the portfolio risk distribution? We need to choose between a concentrated or distributed trading risk distribution. What is concentrated and distributed? Concentrated is when I concentrate my risk in probably just an asset, or probably just a session, or probably in just a contract. Distributed is I distribute my risk based on few different trading sessions, London, New York, Tokyo. I distribute my risk with different contracts, futures, perpetual, CFD. If I understand during the months that most of my results are generating by futures trading and not by CFD, contract for different, probably I should trade more on futures, because futures fit better my strategy. I feel more confident. I like the risk engines of the futures contracts. So you have to understand that your trading strategy need to enter in a distribution way of the risk, and inside the risk distribution there are different way of distribute the risk, like a portfolio way where you understand if it's a concentrated or distributed risk. What is a concentrated and distributed risk in a portfolio long-term investment? You need to understand if you want to concentrate your risk on European market, US stock market, China stock market, Asian stock market in general, or distribute this risk and allow yourself to geolocally invest in many infrastructures, you know. Portfolio risk, another interesting topic is the correlation analysis. If you trade FX, not if you trade crypto, but if you trade FX, you need to understand that if you trade, for example, USD CAD, United States dollar versus the Canadian dollar, okay, you can arrive at a certain point where you understand that probably you should trade oil and see how your trading strategy work with oil, because it's a very correlated asset. Uncorrelated, sorry, it's not symmetric, it's asymmetrics. USD CAD goes long, US oil goes short. I could say another examples based on forex market and commodities, because some and many commodities work in a complete different way but very asymmetrical. Okay, false diversification is the same things of concentrating and distributed risk distribution, and then the beta exposure and the risk clustering. Position sizing, again, size determines survival. This is a good phrase. You should put in your studio and look at it every single day, but yeah, the size determines the survival, because I brought it here. There is no wrong bet, there's bad trades, there is just wrong size. Okay, like when German people say there is no bad wear, just bad clothing. That's it. Okay, you need to be properly prepared to bad weather. Okay, so the position sizing of my trading strategy is really fixed lots per session based on the risk level of the session. I know Monday is a level 2 risk session, and Tuesday normally it's a really low risk session. So my trading strategy is built on how much I can risk per session based on the confirmation that the data give me. Okay, fixed fractional model is the model that I use for risk management. Kelly criterion, I talked about here probably, yeah, the Kelly criterion on the position sizing, the risk parity, fixed fractional, and the Kelly criterion, that it is a formula that is composed by the win percent per the average win less the loss percent and the average loss, and then you have a result allow you to understand how much can you risk in the market based on your strategy. Okay, and then of course we have in the part of the risk distribution the drawdown distribution, because we have to understand that drawdown can be managed as well. Okay, drawdown can be managed. What is something that I never advise to people? Don't use the stop loss. I always say to people, don't use just liquidation prices. Don't use just if the price will drop by 5%, probably gonna liquidate me and I lose money. No. You have to fix, like using a fixed fractional model for entries, but even for exit. Most important things in trading is not just how you manage the trade, but how you exit the trade in a profit situation or in a loss situation. And the most dramatic things are when you are in loss. So you need to understand that your trading strategy needs to be prepared for losses, prepared for drawdown. Drawdown is psychologically as well. Okay, You need capital for making drawdowns. I know, and it happened many times in the past that I was in drawdown and people are in drawdown and they just continue to load capital to allow themselves to not be liquidated by the brokers or liquidated by the firms, you know. And this is a really bad way of manage funds, because you are unrespecting your trading strategy. Okay, so drawdown distribution, you need to plan the worst case scenario. Always plan for the worst trade case scenario. Trading is a game of planning the worst case. Nothing is granted tomorrow. If you think about your strategy and see 50% win rate, good results in the years, guys, your life can change in a seconds. Since today that you are with a past full of results, since today to the future, probably you're not gonna see $1 anymore. Okay, so don't think that everything is granted. Don't think that everything is granted. Yeah, I could not say in any other words. Don't think that the market owe you something. Be prepared for the worst case scenario. Be prepared for drawdowns, but plan the drawdowns in advance. Okay, I think for the masterclass of tonight, we covered just a half of the topics that I wasn't going to explain you, but I think we gave a lot of insights and a lot of interesting, again, data that you need to properly understand before saying to yourself, I'm a profitable or I'm unprofitable trader. Okay, I hope you guys enjoyed the masterclass of tonight. I kind of enjoyed it because I was telling you what I think about these things and what I think about one of the most important things in planning your trading strategy. Okay, that is monitoring, that is data analyzing what you're doing. Okay, I wish you a wonderful night, wish you a wonderful evening, everybody, and I see you in the next week, next Friday, for our masterclass.